Okay, so I'm going to take a minute. Karen Bernardi with the Bernardi Group at Coldwell Banker, and I am not really a dual personality here. We see me on two screens. I'm just registered that way. And I have a few of my team members with me, Rachel and Madison, and then I have Dave and Masood here with us from SunPoint Public Adjusters. And I think I'll let them give a little introduction or a big introduction and talk about what they've been able to do. They were brought to me by some clients of mine that have a high-end property, and I don't think it's necessary that you have necessarily a high-end property to utilize their services. But I was so impressed with their knowledge about how to deal with my client's insurance company that I was like, we've got to get this knowledge out, not only for the people that have been affected by the fires here, but to people that are currently insured and weren't affected by the fires in any way in Boulder and surrounding communities, about what you should look for in your insurance company so that you don't have a problem in the future.
Thank you for the kind words, Karen. My name is Masood Khan. I'm one of the principals at SunPoint Public Adjusters Inc. I've been doing insurance claims since the 1990s. That's solely been my business. My background started as a State Farm claims large loss adjuster. Then I was in California, a licensed lawyer for insurance carriers. I also used to represent real estate brokers when they were in trouble for errors and omissions. And then I got into the public adjusting business back in 2005. So 30 plus years of claims business, and I think probably 5,000 plus total losses. And I think I'm on my 35th wildfire. So that's kind of a brief intro. Dave, why don't you go ahead?
Yeah, I started my career as a business owner in a litigation support firm for about 20 years. Moved on from that. I'm actually a Coldwell Banker licensed real estate agent as well, but that's really on the back burner. 99% of my time is spent helping folks join our team to have us help adjust their claim. So I travel all over the West to do this. And I'm very happy to be here today with you guys.
Oh, thank you. Well,
give you a little bit of a rundown on some of the issues that I think are important to get out there. First of all, we are licensed public adjusters, so we are licensed by the state of Colorado. We are one of the largest firms out in the West. We have an office in Cherry Creek, so we are local. We have a local team organized here right now. We always have to do that in the event of disasters. So
you have a local team here in the Colorado area.
Correct.
So let me ask you, can I interrupt just for a second, because your credentials are just phenomenal, and I was so impressed with you when we were working with my other client. So why would a person they get an adjuster with their insurance agent? Why do they need you, and how are you paid? Things like that.
Good question. So number one, let's focus on the insurance agent. The insurance agent is a salesperson. They're not a claims person. So they're not in the trenches of understanding, interpreting a policy. Most people who have looked at their policy, 99% don't, but most people who do end up looking at it after a loss, they see 50, 60 pages of words, and there's exclusions, limitations, conditions, and other hoops to jump through. So the insurance agent cannot help you, and by law, they're not allowed to adjust claims. So that addresses the insurance claims agent. They're your sales rep, they sell you the policy, they service it. Then comes in the claims adjuster. There are three types of adjusters. There's a company adjuster that works for, say, use an example as State Farm. That's called a staff adjuster. Is an employee at State Farm. He or she has a job to do, and part of that job is to provide some contractual response based on the policy that was sold, but also to have some fiduciary duties to manage the insurance company, which is a for-profit business, and report to their stakeholders the management of their claims funds. So once you have a claim, the insurance companies make money by collecting underwriting premium. They take $1 in for premium, and they pay wages, salaries, rents, expenses, etc. Whatever is left over is an underwriting gain or an underwriting loss. But they also take that money and invest it in the market. So they're making money on it. When you have a loss vested, one of the only ways that an insurance carrier can then try and mitigate their damage is by reducing their claim payout by the best means possible that they've got. And they're quite adept at that. And I'm not here to bash insurance carriers because they are a necessity to our society and they are the backbone of commerce. However, they have some very sophisticated tools that they use. So for example, if they've got 5,000 policyholders throughout the country that have had a particular insurance company and they save $100,000 per policyholder on a total loss, that's $500 million. So the compounding effect of numbers is tremendous. And there's always
$500 million, the B word.
yes.
Oh my gosh.
That's just 5,000 policyholders with $100,000.
Right.
So, you start doing math that way, you then get the incentive and understand that the insurance company is incentivized to make you prove your claim. So that's important. The claims adjuster is there to prepare the claim for the insurance company. So why you would get an advocate for yourself is it's multifaceted. Money certainly is an aspect of it, but there's also the stress and burden. Would you advise your clients to go sell their home by themselves? Or would you advise I'm a licensed broker. I'm a lawyer myself and licensed in California, not Colorado. I would not sell my own house. I'd get a broker to do it. So it's akin to that. My taxes. I'm an extremely smart, bright person. I don't do my taxes. I got a couple of LLCs. I own SunPoint. I've got my personal taxes. I go to my tax professional and I huddle up with my tax professional and I say, hey, what can we legitimately deduct? What incomes need to be reported? And then we prepare a return and we go to the IRS and we say, hey, give us a check. As opposed to taking a bag of receipts and saying, here you go, how much money do we owe you? So,
well, and in this case especially, I can see, I mean, I was getting 50 phone calls a day because I've been selling real estate for over 40 years, so I'm getting, 50 phone calls a day from people that I sold their houses to. Your clients, my clients that called me and I sold them their house 25 years ago.
right.
And they're all calling me saying, what can I do? The stress level is up to here.
Oh, I know.
They don't have underwear. They don't have socks. They don't have a toothbrush. They don't have pants. They left their house with some in their robes because the fire happened so quickly. And then they're trying to find a place to live, try to keep their kids in school, try to keep their own personal jobs going because their employers may be in California. Maybe they worked from home. I mean, the things
that's the part that we take off their hands.
Exactly.
Yeah, the stress and burden. And look, you raise so many issues, and we could go on for hours. And I know that we've got limited on time with your availability, Karen. So you want to focus on that. One big, and we were talking initially, in my experience of 30 plus years of doing this, there's a pack of folks like this. And 98% come out of the gate saying, we want to rebuild because we survived this. We're going to come back strong. And there's a lot of folks at the end that are somewhat stragglers, can't make a decision. And there's folks in the middle. And I kind of like the middle of the middle, or the rear of the middle is probably the best spot because you're going to see the folks in the front make mistakes. Right now, the county is going to tell you, hey, we're going to waive all these code requirements. We're going to take care of this debris removal. We're going to make this process easy for you. Time and time again for decades, I've seen folks, insurance companies, regulators, county agencies walk back on the initial honeymoon stage. And, I think that intentions are in the right spot, but then there's a reality aspect to it. So, you really need to develop your budget with your insurance company first before, for example, you go out and buy a home. So this audience sells homes. We prepare, as I was showing earlier, this is a sample of a claim that I did in Malibu for a gentleman who had lost a home. And there was a couple of $1 million, and we had to prepare the budget. So that way he was able to prove his claim to his insurance company. Then he knew how much money he had. And then he went out and bought the home. Here's the example. Your policy is an indemnity contract. This process is not about just getting numbers from a contractor. You have to understand what your policy gives you. So under the terms of your policy, if you bought your house for $3 million, that's the fair market value. But that is not the value to rebuild it. To construct that house today, that 5,000 square foot house today, it might cost you $4.2 million.
Or $5 million.
Or $5 million. And so if you've got coverage to $5 million, the last thing you want to do is engage a contractor or go out and buy a house for $3 million, which is somewhat similar in size, perhaps, to what you had. And you're now leaving legitimately money that you're entitled to according to the terms of your contract, for which you paid premiums for which the insurance company had the financial enjoyment of and benefit of the premium. So you really have to separate the recovery from your indemnity, and you want to indemnify yourself first. And you have a multitude of options.
Let's just go back, because I know I'm really slow about the indemnity thing. So you're indemnified. So let's say you, because I've got a lot of people now that are calling me, their insurance company is not, I would say, indemnifying them for the replacement cost. Maybe they were insured for something like, they had a 5,000 square foot home and their insurance was, for 800,000. Well, you can't build that home.
No, you can't. So that's
now they bought the home, 5 years ago or 8 years ago or 10 years ago. Maybe that was enough then.
Right.
So what happens?
Okay, so that's a huge topic. Let me footnote that for just one quick second, because what I wanted, and I will answer your question. What I wanted to tell you was, on the indemnification side, you want to get your budget first, number one. Okay, that's the most important thing. So you know what you've got, and this is obviously assuming there's not an underinsurance issue, because that's a very, very sensitive topic. And I'm involved with a national organization called United Policyholders. It's a consumer advocacy group, and I'm on the advisory council, and we are dealing with this issue nationwide. We're dealing with this. So there are 4 options that people have. You can rebuild your home on site. You can rebuild your home elsewhere. You can replace your home elsewhere, or you can cash out. All 4 options have certain outcomes and certain pathways to take. So if you're 70 years old and your kids are in New York and you want to be closer to them, maybe that individual or that couple may want to move out of state. I've had some clients who are plastic surgeons. They've got a plastic surgery clinic here. They've got kids. They're tied to their business. They're tied to the kids' school. They're probably tied to the community. That's their support network. They might need to rebuild. I've got other clients who now are looking at this thing and saying, look, I've got enough insurance. I hated my lot. I really didn't like the way it was cut, or I didn't like the folks I live with. So I'm going to keep my lot. I'm going to maximize my recovery. I'm going to go buy down there. So those are all options that are out there. They need to be customized to each individual so they understand what their recovery is. So that's on the building side. Keep in mind, there's another aspect to it. Another big book, unfortunately. This is the contents claim, and this is where we really excel, because we prepare the contents claim for clients also. And I'm going to keep that as a separate segue, because I want to focus on the real estate aspect of things. You asked me about underinsurance. Underinsurance is a huge, huge issue. It is very, very factually driven. Unfortunately, the law in most states, particularly in the Western jurisdictions, is not very favorable to insurers. Generally speaking, and my disclaimer here is I'm not giving any legal advice, please, but I'm just giving you my observation from my experience with claims in the Pacific Northwest, Western region, going in from Colorado, Utah, Idaho, Washington, Oregon, California. So these insurance companies typically shift the burden onto the insured to check their policy and become responsible for the amount of insurance. And there are ways to overcome it. You have to show that the agent, conducted an overt act and took it upon themselves to dissuade the insured or tell the insured why they shouldn't get the insurance they're requesting. I think you and I talked about one of my clients out of the Napa, Sonoma area, who was a doctor, and I'm not going to name the insurance company, but it's one of the big 3. His lender told him after the refi, he needed $1.4 million in insurance. This is in 2017. And when he went to his agent said, You've got 500,000. That should be enough. Foundations don't burn. He fought with him. Lender wouldn't agree to it. They finally closed. He gave him insurance of roughly $900,000. Guess what? His loss was over $2 million because the Tubbs fire destroyed 8,908 structures. So obviously in that scenario, we were able to develop a set of facts that allowed my client to recover after, quite frankly, a little bit of a fight because the insurance companies resist paying claims when they've underinsured somebody because you're now telling an insurance company, hey, your product is wrong. The way you calculated my insurance is wrong. And the insurance company is saying, no, wait a second. I sent you a renewal every year. And in bold print, I've got there saying, you know, this might be your market value, and market value is not the same as replacement cost value. So there's a little bit of that. You know, again, I don't want to be the naysayer for carriers, but, you know, most folks don't read that. And
well, they also, maybe they're trying to save the person money. I mean, they're not trying to be mean, I'm sure, not trying to be deceitful or nothing with malfeasance involved. So here in the Colorado area in Louisville, where the fire principally was, they are saying that, you know, they've set up an organization through FEMA, of course. And FEMA is saying that they will cover some of the difference, but it's going to be a loan. Have you dealt with any of that before?
Yes, I have. Very common for FEMA and SBA to come in. You have to, with FEMA, you have to exhaust all alternative remedies. And I will tell you that FEMA, the IRS, need I say anymore, when you're dealing with a government bureaucracy, it's going to be like that. So with FEMA, you got to exhaust all your alternative resources. So you got to exhaust your policy before you can tap into their emergency funds. Same thing with the SBA loans that are being put out there. I encourage people to look into it, but don't have a major expectation on it because, again, you have to exhaust all your options out before those remedies typically are triggered.
Well, we know we had a flood in our area, you know, probably 12 years ago or so. And during that time, people did get some money from FEMA, but it wasn't a loan. And now what I'm hearing from my clients now is this FEMA is turning out to be a loan, you know, the differential, and they don't want to take on more debt. Right. That's not what they're wanting. You know, they're like, wait a minute, we just want my house back.
Yeah, and look, it works for some people. I mean, some folks folks who are in the real estate business, they love leverage. Why should I use my money when I can use yours for cheap, right? So that's one approach. Others are very conservative fiscally, and they say, I don't like that. I don't want that. And so I get it. And again, it's not, you know, you can't fit every peg in that.
No,
in the hole.
Of course. So. Yeah. So the best thing is, you know, is to contact you and see what they can do. Can you give us, and maybe Dave, you could share a little bit, what you see? I loved the 4 points, you know, that you gave us about their options. What are the major mistakes you see people making at first that, you know, later they call you and they go, oh my God. And you say, oh, I wish you would have called us 3 months ago or 2 months ago or 2 weeks ago. So tell us if you've seen mistakes of people that didn't call sooner that you could have helped, some scenarios might help us.
Yeah, I think, Dave, you might want to touch the ALE replacement housing issue. That's very critical. That's the first step in this process. So go ahead.
Sure. So yeah, a lot of folks, they rush out to get into a rental home. We've had some clients that they were so worried that the rental housing market it's so small that they were living in a 3,000 or 4,000 square foot home, and now they're in an apartment. Well, they are entitled to the same standard of living that they had prior to the fire, and so by jumping at something that is substandard, they're leaving thousands and thousands or hundreds of thousands of dollars on the table. So most of your additional living expense is either 12 or 24 months, and it usually has a cap on the dollar amount. And we would work with the insurance. We would negotiate with the insurance company to maximize that dollar amount and sometimes even get a payout.
So
so
one of
that
the ways to deal with that, Karen, is there's 2 or 3 issues that get implicated. One, let me just piggyback on what Dave said. You go out and you rent a home because you're desperate. You can't find a spot. And you had a 5,000 custom built house, and now you get yourself into a 3-bedroom, 2-bath condo. You prejudice your rights because now you've kind of set an artificially low floor with the carrier saying, hey, this is my budgetary number. You're not looking at the long process because you might be into this for 24 to 36 months, period, if you're rebuilding. So you don't want to tie yourself to that. That's number one. Some people will go out and say, you know what? I don't want to deal with this nonsense. There's a house down the road. I got money in my bank account. I'm going to go buy the house. If you make that mistake, you cut off your extended replacement cost benefits, which sometimes could be 100%. You cut off your code upgrade benefits. You can potentially cut off your loss of use, and you've permanently relocated. So you're losing money, period. Yet others will go out and say, you know, I really want to build my house where I was at. And I don't want to rent in somebody else's house, whether even if it's 4,000 or 5,000 square feet. I'm going to go out and buy a smaller home. I'm going to live in that for a few years. I'll take the debt on it, and I'll work something out with my insurance company. But you know, I'm going to live there for a period of time while I'm building my house. You're potentially relocating, so you're cutting off benefits. So those are steps that insureds must be very, very careful and deliberate before they execute the decision. So for instance, I've got one client right now who was contemplating something like this. And I said, look, you know, one, you don't want to do this without running it by your insurance company, because you don't want to get into a concealment or misrepresentation issue. But most importantly, get yourself situated for these first 4 months or so you can get your bearings, get your job, get your daughters under control, get your life a little bit together, and then take the next step. So that's kind of important to keep in mind on the additional living expense side. We see that as a big mistake.
Oh, well, that's interesting. So how long should somebody, I mean, so you could step in and start negotiating with their adjuster that's saying, oh, I'm going to give you, you know, $3,000 a month. I mean, I had one client where their adjuster told them, well, you're entitled to what your house would have rented for on the day that it burned down.
That's wrong. Who's the carrier? That's actually incorrect.
I don't know, but you know, but I do know that that's what they told her.
Yeah.
And she was like, and I said, well, that's not the market now.
No, that's
you know,
wrong.
when we lost 1,000 homes in our market, needless to say, the rental market boosted up quite a bit.
Yeah, so here's the way the coverage works. You know, if there's a covered loss, we will owe you to maintain your standard of living as for the period of restoration, not to exceed a period of 24 months. That's the general policy.
Okay.
In which sometimes you've got a dollar cap. What a lot of these insurers, you know, the large ones, and I think we've seen all the ads with the lizard folks and the good neighbor folks and so on and so forth, they have catastrophe teams. They are going to bring in adjusters from Texas, North Carolina, or other states because they're overwhelmed. They're not nuanced in the regulatory issues or the policy issues sometimes of Colorado. They typically get routed through an induction center. They get an introduction in. They've done a lot of disasters, but it's a very vanilla flavored process. And so this is where the insurance adjuster is following instructions of his principal. His master is the insurance carrier. Mm-hmm. And the insurance management team is saying, look, you're going to determine additional living expense by telling them that their budget is the fair rental value of their house a minute before the fire. My position is, tell me where it says that in the contract. You wrote it. It's a contract of adhesion. I don't see it in there. So that's an incorrect statement, and that's 98% of the people will accept it and they'll move on, but they don't realize that they're entitled to it. And this is across the board with all policies pretty much.
So let's talk about just for a second then, you know, how they would reach you. And is there well, first of all, let's talk about who should reach you. Is there a dollar amount, like say if a person has a home that was $1 million, which almost everyone that burnt down. Now, you have to understand they would think their market value would be, maybe 800 to $1.2 million on a lot of these properties, but that wasn't true. They were higher than that,
Right.
So
We don't necessarily at the early stage, we obviously phase these seminars out. I think our primary focus is the folks who, as you said, are out on the street. I've had clients who have run out of the fire with their shoes on fire throughout the years. So, I've had clients who, one client of mine who got trapped in her car and kind of just gave up, and her son from Florida called the sheriff, and he drove up to the house and dragged her out of the fire. So, our main focus is for folks who lost their homes, because they have the most urgent pressing need. I tell people, forget about the house and the contractor and the rebuilding and the inventory right now. Focus on yourself. That is key, because that's part of what we do. Is we are, I guess, counselors and therapists to a degree, because we're with our clients throughout the way. So we don't really have a major threshold, but we are focusing primarily on folks who've suffered a total loss, so we can guide them. Now, in many instances, you might have an executive, maybe a doctor, maybe an attorney, maybe somebody who's a mechanic, so somebody who's a plumber who's running their business, they've got kids. So we represent the whole gamut. And I literally describe it from the Uber driver to the mechanic to Cindy Crawford and Miley Cyrus, who are my personal clients. So for us, this is about getting information out. I'll send you, obviously, Dave and my contact. You've got my firm website.
Yes, yeah.
We're all reachable there. But our main goal first is to get the info out, to get people situated, and then.
Well, that's what we wanted to do, because people are really lost. I mean, so many are lost, and they're totally overwhelmed. You have to imagine, people are trying to go on with their lives.
Right.
And, this was a period that, on break. And so they're trying to get their kids back in school. The kids have it just goes on and on.
It's a mess, and COVID doesn't help. And,
No, because of supply chains and whatever. So, and then what is the cost? Who pays for this? Who pays for this service that you guys
Okay,
have?
so just like, realtors, and Dave, I'll let you chime in a little bit too. I mean, keep in mind, Karen, I'm not a salesperson. I'm one of the principals of the firm, so I will call it out straight. We become partners in our clients' recovery, and our fees they range between 8 to 10%. They range between 8 to 10%. That includes all our costs to put the claim together. There's obviously some flexibility on fees. It depends on a few things. Number one, if you're a referral to me from a client, existing client, prior client, a brother, cousin, family friend, etc., obviously we factor that in. Second, when we get involved. Third, how big is your loss? Fourth, how complicated is your loss? So the friends and family discount is easy. Early involvement is critical. You call us 3 months out after the insurance companies publish their reserves, they've prepared their estimates, their numbers have cemented. You have not taken the time frame to prove your claim, and now I got to take a jackhammer and chisel away at it. That makes our fee a little bit rigid. Okay, so early involvement is key, because then we can guide the insurance company in the direction we want them to go, because each client will want an individual outcome. So early involvement really affects our flexibility.
I get that, because once the insurance company has made up their mind,
then
you have to try to change it. That's not good.
Really tough. Really tough. Okay. Second, how complicated is your loss? I mean, look, we've handled losses from $750,000. The largest claim I've ever handled in my career is $280 million. So, obviously these residential homes, they will typically, when you're in some of these high-end areas like Boulder and the vicinity, you're going to be in the $2 to $5 million range easy. In that, and of course it depends on the insurance side, because you've got contents, loss of use, code upgrade, debris removal, additional coverages, building coverage, building extension coverage, and other structures. So there's all of these, and landscaping. So you got all these categories to touch. And if you don't, so let me give you an example. This is how we think. I take your, God forbid your house burns down, and I'm taking your house now imaginary, and I pick it up and I turn it upside down and I shake it. Whatever falls out is contents. whatever's in my hand is real estate. But I've got now some stuff hanging off of it. Maybe the dishwasher's hanging. Maybe the refrigerator's hanging because it's got a supply line. Maybe there's another appliance hanging off of it. Now, if my contents limit is exhausted, I'm going to go to the insurance company and I'm going to make an argument that, look, this item is attached to the real estate. It's part of the realty, covered it under the building. Sometimes you might have another structure outside, such as a jacuzzi or a spa, that might be connected by some kind of a utility connection that arguably brings it under the building coverage. And the insurance company is trying to put it under other structures coverage, which tends to be lower. Mm-hmm. So, if you don't chart out and plan out these issues as to how you're going to recover all of the nickels and dimes that add up to the dollars, you will leave money on the table. So going back to the issue of the fees, the second part of it was, how large is your loss? Obviously, if we represent, for instance, I did a fire in Wenatchee, Washington, and I represented 28 homeowners on Maiden Lane. So there were economies of scale. Literally, I went from one house like this, like that, like this, like that. So my entire team of construction experts, my entire team of inventory experts, and me and my co-adjuster, we spent our life down the road, and every day we were on Maiden Lane, meeting with adjusters and the various army of consultants that the insurance company brings by. So if we get, say, a neighborhood, obviously there's economies of scale, there's some flexibility in our fee. And then finally,
I would think that, I just wanted to say real quickly that I think that a lot of people would be surprised, especially in the Louisville area, which is just 5 minutes from my house here in Boulder. They are going to be surprised about how much their values really were. That when they rebuild, these houses are going to be $1.5–2 million houses and maybe above. Before, they may have been 1–2, but they're going to be brand new now. Everything kind of changes, and the market has really gone up. But I loved what you said about the landscaping, things that you don't think about.
Yeah, and listen, I got to tell you, Karen, this is the long game. I don't care if somebody is got resources and they can pull the trigger tomorrow. Either way, it's moving the pieces on the chessboard and strategically understanding how you want to balance the stress and burden of your life with your economic recovery. Because for some folks, it's going to be all about dollars and cents. For other folks, it's going to be about stress and burden. And for most folks, it's going to be a combination of both. And at the end of the day, the common mutual goal, because we're partners in our clients' recovery, we don't get paid by the hour. We're a contingency model. Right. We get paid when our clients get paid. So if we create a work product, money comes in 3, 4, 5, 6 months out, we get paid then. Initially, the insurance company right now in Colorado, by the way, the law is, as we understand it from the regulatory agency, is to issue an advance of 30% on contents. Some insurers are paying the 30% on contents, and they're also, some of them are paying 50%.
Oh, so, I know.
And
it's just really awful in that way. Really.
Well,
awful.
Yes, because what they're doing is, my response to that is, I had a total loss. Why are you holding my 70%? Give me my limit. Right. And they're
right, because think if you've got a mountain bike, replace that at 30%. Now during COVID, when you can't even find a mountain bike. I mean, these things are important to people. Skis, boots, poles, goggles for, just the stuff that you can't think about. So with the way that I like to look at it in real estate and what I'm seeing from you, we work on a percentage as well. I mean, obviously, the more money I get my client when I sell their home, the more money I make.
Yes.
I don't want to seem, like I'm being greedy, but I don't look at it that way. But I also know that I generally make my fee out for them because of what the value that I bring them. And what I can see for you is that if you can bring them the extra 8 or 10%, it's free money to them.
I will tell you that, first of all, look, as somebody who's licensed in California as a broker, I know the fiduciary rules that real estate agents and brokers have. So we obviously, when we're handling and transacting money, we are very, very conscious that on any given day we do a poor job, we are getting our clients 30% more. We've got references from all kinds of folks where the recovery has been from 100 to 1,000% above and beyond.
Oh, and my God.
Including wildfire losses. So happy to share references with people. all folks from all walks of life. As I said, the Uber driver, the mechanic, the executive, Hutch Parker, chairman of Fox Studios, Miley Cyrus, so on and so forth. I mean, just across the board, we've done it. So I think the fee pays for itself because the stress and burden comes out. We're incentivized to maximize your recovery. We don't charge a bill until the money comes in. So, you know, in our mind, it's a no-brainer. It's kind of like going to a real estate broker who's good at what they do, who will get you the highest value for your house.
I see it. Well, thank you so much. Go ahead and give us some of your contact information, and we will publish it on the screen. But
okay, so do you want me? How do you want me to share the contact?
But just right now, just give us a phone number or an email.
Oh, okay, great. Let me just actually grab something real quick.
Okay.
Just bear with me a second.
Really valuable, wasn't it, Rachel and Madison?
Obviously, the best way to reach us is cell phones and emails, and I will put my cell phone up. My name is Masood, Masood as in David. Last name is Khan, Khan. My cell phone is 415-271-2612. 415-271-2612. I have a local office number in Denver here on my card. My email is Masood, Masood as in David, at sunpoint.us, not .com.us. So best way to actually find us is very easy. And I'll let David also cover his card. In my case, the best way is just Google us. SunPoint Public Adjusters.
Of course, yes.
You'll see my entire team, my 4 other partners, Greg Clifford, Steve Boydston, Gary Johnson, Tony Estone, myself. We're the 5 principals. And then we've got an army of experts that has been fighting insurance companies for decades doing this.
Good. That's great. Dave,
if you don't get a hold of Masood, let's see here. My number is 720-365-0532, and it's Dave Wilkinson. And we really appreciate your time.
Oh, no, we appreciate your time. I mean, I'm not an insurance expert, but there's so many things that, I'm going to do a list of, this is what you should be looking for in your policy. And do you have anybody at like a service that you would review someone's policy before they have a
Absolutely. Absolutely. I just wanted to, in closing, bring that exact issue up. If somebody needs a survey, we will do that.
I'm going to do it. You're hired with me. You're hired.
We don't charge for that. Our consult is free, as you know.
My goodness.
Time today. I think the few things that I really want people to take away from this, because I know I had an agenda, but there's 3 or 4 really important points. Number 1, to rebuild or replace, please don't forget, you have 4 options. Rebuild on site, rebuild elsewhere, replace elsewhere, in the area or in a different state. You could even go to Honolulu if you want, or cap out. You have 4 options, okay?
We'll take care of those.
That's an important thing. Number 2 is your temporary living expense. You got to set the stage early, and you got to set it quick, and you got to set it right, because otherwise you will go batty, and it's going to take a lot of toll on your work environment. And then finally, don't worry about the personal property and building claims. Those processes will play out. Folks are right now scrambling for debris removal. Some of my team members were at the community program, and they were talking about the nuances of how they're going to get rid of the household hazard waste and do debris removal. I would urge people to step back and not just engage automatically the government program that they're offering. It may work for them, it may not. I've had clients, but I've told them, don't do the government program. You're number 256 on the spot. Why you're rebuilding? Why do you want to wait? You've got $400,000 of debris removal coverage that your insurance company will give you only if you do the work. Why are you going with the government contractor who's going to ruin your lot potentially?
You know, I could talk to you all day because this is such an important topic right now, but
I know.
I have to go to an appointment. All right, I appreciate
We'll let you run. I don't know
Thank you.
if Madison or others have questions, but you've got a contact info. So
Okay, we thank you much.
Thank you.
All right,
Thank
thank
you.
you. Bye-bye.
You.
Bye.
Thank you so much, guys. We really appreciate it. This is great.
Yeah,
Bye.
incredible. Thank you.
Thank you.
Bye.